GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk with you. Thanks for having me.
Gold has been stuttering around. What kind of a direction do you think it's going to go in?
Well, last year, of course, gold stocks were among the top-performing things in the entire stock market. They finished the year up about 51%, even though they had a big correction from the summer into the end of the year that really continued over into this year. But the funny thing is, with all the ups and downs, gold tested 1,300 a couple times this year and came back down, and now we're around 1,240. And frankly, I can tell you that most people have given up on gold, or they're just bored of it, no one's bullish on it. I can tell you that from feedback I get, and there's actually lots of people predicting crashes. Harry Dent is predicting gold to go to $700, and this is kind of typical of something that's been years away from making a top. All-time, top was back in, it's been over 6 years, and it makes people get more bearish and just not many people interested. But, and if you look at the GDX Gold Stock ETF right now, despite all these ups and downs, it's basically where it started the year at. Now, I think we have a good chance, though, that it's going to turn up, and if gold finally does go through 1,300, people will then get excited and start to buy and start to want to get into it and so forth. But I prefer to be in early before the masses jump on, so I invest now. I've got positions now in mining stocks and gold, and I'm very happy to own them. But here's what I'm looking at is two things. First, gold has pulled back below 1,300. We had that Fed meeting last week, and it sold the news. And so far this week, it's just going sideways and forming a base on the hourly chart, which is exactly the same thing it did in December and in May after the Fed meetings then, and then it had a rally. In the gold stocks is the second thing I'm looking at. They're starting to outperform gold, which is a leading indicator and a bullish indicator. Today, as we're speaking, the GDX is up, and gold and silver are barely up at all. I think silver is actually in the red. So that's a short-term positive. And if you look at GDX, it's had resistance now about $24, and support's really where it is, a little bit below where it is. So that's a 5% range. And so I think this is a good time to buy and take a position. If we break $24, and we're going to be having a rally, much like we saw last year. I can't predict, though, if that's going to happen tomorrow or next week or next month. But making money, I don't think in the long run is about predicting things exactly, but taking positions and stuff that are of such a size that you don't get shaken out of them, because there's always news out there and bearish talk, no matter what you're following, that can shake you out. And I think it's time to hold the course, and that's what I advocate people to do. And if we do break through that 24, I mean, it could happen in one single day. Just take the Dow falling 200 or 300 points, and gold will shoot up, and it'd be like overnight. So we're just like a coiled spring, in my view, ready to go, or no one's paying attention to it. That's why I want to talk about that at the start of the interview, to make sure people are.
Would it be a good idea to do cost averaging with gold right now, by a little bit every month?
Well, that's in a way sort of what I do. The way I invest my money is I'll take a allocate a percentage of my portfolio to one sector or one trade. So we'll use gold as an example. Let's say I want to have 20% of my money in gold stocks. Well, I'll just put 20% of my money in gold stocks, and if they dip, I no longer got 20% of my money in it, and I'll buy more to get back up to 20%. So that's sort of how I do my dollar cost averaging. That way, when something goes up, I'm not trying to chase it and just keep buying and buying and buying, which is, unfortunately, what most people really kind of do is they kind of get scared to buy something when it's at a low price, and then they wait for it to go up, and then they just start chasing it higher. But dollar cost averaging works best for people that, are putting a certain amount of money every month into their brokerage account and doing it, from their paycheck or something. There's nothing wrong with that, certainly. I think the most important thing is to have some sort of system. So when it comes to what you're doing with your money, how much you're putting in something, and when you're doing it. So, yeah, for some people, dollar cost averaging would work as long as they stick to what their plan is. So I'm doing it my way, and, as long as people have a plan that's beyond, well, this is up, I'm going to start chasing, and the higher it goes, the more I buy, which I could tell you that's what people do, looking at, for instance, the Ameritrade index, which is something Ameritrade puts out every month. They tell you what are the most popular stocks people are buying, and then every month it's almost something that's gone up the most that month. So I try to get people to do the opposite of that.
We'll have more with Mike Swanson right after the break.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're chatting with Mike Swanson. Mike, the Fed did a tiny increase in the interest rate. Do you see them doing it again this year?
I doubt it. And that's huge because as we came into this year, the Federal Reserve was predicting it would do 4 rate hikes. Now, it's done 2. As you said, the last one was last week. And the funny thing is, in the statement they released, they stuck to the predictions they made of doing more this year and more next year even. But the financial markets don't believe it. The Fed Fund futures are projecting a 40% chance of a hike in December. And more importantly, the long-term bonds have actually fallen since they made their rate hike. The 10-year bond has dropped in yield, which means that the spread between long-term rates and the shorter-term rates, which the Fed has control of, is narrowing, and the Fed isn't going to want to raise rates above the long-term rates. They're not going to want to take 1- and 2-year interest rates above the 10-year rate, or they're going to get an inverted yield curve and make a total mess. So I think we've probably reached the end of the tightening cycle. In fact, this morning there's a Fed Fund official, Evans, who said, well, we're probably going to have to wait to December now whether to hike or not hike. Now, I think any stock market pullback of any amount, 5%, would take an interest rate hike off the table. And I know the market's up this year and the volatility has vanished, but I find it hard to believe that the market won't fall at least 5% between now and the end of the year at some point. So I really think it's highly unlikely we'll see another rate hike, and that means we're at the end of the cycle. And historically, if you look at what happens at the end of a tightening cycle, The last two times was the summer 2000. The stock market rolled over in the fall, and the economy went into a recession. In 2006 was the next time that we entered the end of a rate hike cycle, and that coincided with the peak in real estate prices in the United States. The stock market did continue higher for about another year, but then it went back down. And during that transition into a bear market, in both those previous two bear cycles we've seen, the Fed actually went into panic and cut the rates real rapidly. So I don't think that's going to happen this fall, but at some point next year we could see the Fed take these rate hikes back. But the best case scenario, I think, is that things just stay the way they are and nothing really changes, and the interest rates, don't go down or they don't go up, and it just kind of floats there, and eventually the imbalances in the economy kind of get worked off. But that's kind of a hopeful thing. That's basically what Ben Bernanke was saying was going to happen in 2006. And then, and the other factor I think it's worth paying attention to is oil prices and commodity prices in general have been falling this year, which is a sign of disinflation. The CPI was actually negative for last month, and oil is now right above $40 a barrel. It was over $50 just a few weeks ago. Oil stocks are among the worst performing sectors of the entire stock market this year. The DBA ETF, which is a commodity agriculture ETF, is down today substantially. It's near all-time lows. So, and what's funny about all this is seasonally oil goes up in June and July, and so do all these other commodities. And when something in the markets doesn't do what it historically is supposed to do, that's a warning sign. So, that I think there could be multiple reasons why all these different commodities are declining, but I would say possible economic weakness in China, maybe even in the United States, is the reason this is happening with agriculture commodities. Oil, they talk about oversupply now and multiple factors, but bottom line is that disinflation is another reason for low interest rates and not to expect the Fed to raise again. And the thing about it is that's another reason to be bullish on gold, because when the Fed ends an interest rate tightening cycle, that tends to bring a bull market for gold and gold stocks, and at the least minimum outperformance to the rest of the stock market. That's what happened and started to happen in the summer of 2007. The gold and gold stocks outperformed the market starting around August that year. And in the fall of 2000, gold and gold stocks also made critical bottoms in what had been a long bear market for them at that time, and went up for about 8 years. So I think we're actually at a fundamentally sound moment to be betting on gold and mining stocks, at least moving some money into them if you don't already have any in, because so many people in the United States are just fully invested in the stock market. I even know people who had bought CDs and had a lot of their money in CDs after 2008 because they got sick of losing money in the stock market, and they've now moved all their money into the stock market. No, nothing that's safe, nothing diversified, but, owning the spiders and NASDAQ stocks, and that's just not a good thing to be doing nowadays. And I just hope, people reduce their risks at this moment.
We'll have more with Mike Swanson right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with Mike Swanson. Mike, Iran says OPEC might cut production even further, and they say so far there's 106% compliance with their production freeze. In other words, countries that weren't even part of the formal agreement are taking part in it. Is that enough to overcome the flood of oil from fracking in the U.S.?
Surprisingly, I don't think it is. We've been seeing stories over the past couple of weeks, if you read the Wall Street Journal and Bloomberg, that the oil fracking in the United States is increasing, that it's doing very well, and it's creating a glut. In fact, the glut's so big that Trump is talking about doing away with the government's oil stockpile, saying, well, we make so much now, we don't need this emergency stockpile anymore. And the thing about the OPEC stuff, too, is we now have this tense situation with Saudi Arabia and Qatar, where the region could become diplomatically, well, it actually is, destabilized, and that could make it harder for OPEC to come to agreements and actually implement them. In fact, when that Qatar crisis actually started and Saudi Arabia and its allies broke off relations with that Gulf state, oil prices actually dropped, which is funny. You know, you think there's going to be a Middle East tension, prices go up, but they actually dropped because the rumor was that this would mean that other countries would refuse to cooperate or would cheat on the OPEC agreements. And that's the big problem with OPEC at this point, too, is, you know, they don't really have a real enforcement mechanism. It's just a gentleman's agreement. And when one country starts to, you know, threaten another one, why should they obey it anymore? So I think that's a big problem OPEC's got. Very short-sighted, I think, Saudi Arabia.
Of course, Canada and the U.S., too, could very well just say we don't need oil for the Middle East now, ever. We have enough here. How would that affect things?
Well, that's actually that's kind of the position that Saudi Arabia has gotten itself into. In 2014, the last oil bull market topped out, and there's massive short positions in the commercial market, the futures market, and oil tumbled that fall. And the Saudi oil minister announced that he wanted the prices to drop to specifically wreck American fracking companies and put them out of business in order to steal market share. And here we are a couple years later, and the opposite has happened. Oil prices have indeed fallen, just as he wanted them to do, but they have still lost their oil share because the American fracking companies have survived. I mean, some of them did go under, but enough of them survived, and they've taken more of the market share in the United States. And the same thing is going on with the Canadian oil companies. So, for once, this seems to be, you know, over the years, a Saudi operation, if at least it started as one, that has basically been a failure. So I think we're, you know, the end of it, though, is we are in an oil bear market. If you just look at the charts, like I was saying, oil stocks are the worst sector of the year. Now, I would like to one day invest in them because they pay good dividends. Oil's not going away. I have no way to predict price it's going to bottom at, but I think this is where using charts like technical analysis works, or comes in handy, because you can just read the trends and look for signs of bottom. And an important sign is what happens in the futures market, because in the summer 2014, they built a record short position ahead of the drop. And by the bottom of 2016, most of the short positions were gone. And now, if you look what happened this year, once again, there's a record short position built in February with the commercials in the oil market that actually surpassed the one they had in 2014. So here we are falling, and one thing we can do is look at these weekly commitment of traders reports and just be patient and wait for the day when this giant short position is vastly reduced before we start to, nibble and take positions. But I think it will be a very rewarding investment opportunity, just like gold was and gold stocks were last year in January, February. You had a tremendous rally, and they're still up a lot from those lows, and I think they're getting in the position to go again, and that's what you have, and something that's early in a bull market. But here we looking at oil late in the bear market, so we just have to be patient and figure out how much do we want to invest in that when it's over with. And it's not to say maybe if people already have investments, then it doesn't mean they should necessarily sell them, but make sure they're not 100% invested and get shaken out if it declines more.
Mike, thank you so much for chatting with us.
Thank you. Great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show or our guests can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.